we're in a bull market, seems like everything is going up, and over time things go up. Why can't I just buy the shares and forget about it, or buy the shares and trade the shares? That's what I should be doing. Well, that is an antiquated thought process. It's an antiquated thought process. It's leaving potentially thousands of dollars on the table by. In this video, we're going to discuss how to start trading stocks as a complete beginner. We're going to take a different type of approach with this topic because we believe you should learn options first before you start trading stocks. And let's say you're trying to do this as a long-term endeavor. You need to understand options at a very, very basic level so that you can purchase the stocks that you are looking to own at a discount. 100% of the time, you can purchase stock that you want to own in a company at a discount, regardless if it's Apple, Tesla, Nvidia, whatever it may be. You can get it at a discount 100% of the time if you learn how to use options, at least on a very basic level. Now, this video is not going to be on the basics of options. We have a lot of videos on that, and we encourage you to go to our YouTube channel or review our YouTube channel to look at a lot of different videos on the basics of options. But this video is on using options to start as a complete beginner with trading stocks by talking about 4 strategies. You can learn 4 strategies. It can make you an awesome, let me repeat that, an awesome stock trader because you're marrying shares with options, which just makes the combination phenomenal. You can have unlimited upside still, just like when you obviously buy stock, you have unlimited upside with no time decay. Options have time decay. If you're new to options, you'll understand what that means down the road. But when you buy stock or you're trading stock, you have risk to the downside if you're buying it. You have risk to the upside if you're selling it. But in this case, we're talking about buying it because almost 100% of retails buy stock when they trade in it, and almost 100% of professionals buy stock when they're trading it. But if you marry options to the stocks you're trading, you can protect yourself to the downside to at least a certain point. You can always be lowering your cost basis on the shares you own, not just from a dividend if the stock pays a dividend, but also from the options you sell on your stock. So what we're going to be talking about is if you can own 100 shares of a stock of any company, Apple, Tesla, Nvidia, Microsoft, whoever out there, if you can own 100 shares, that's like owning a house that you can rent out. Those shares are a property that you can rent out just like a landlord. You can become a landlord in the open market, right? For a fraction of the price of actually truly becoming a landlord. You can sell options against your shares to always lower your cost basis. And what I mean by your cost basis is that if you got into Apple at $10,000 and every time you get a dividend, that lowers your cost basis to something less than $10,000. Well, if you also marry or connect or use options, you can lower your cost basis continuously as you sell those options against the shares. As you rent those shares out on a weekly, monthly, quarterly, yearly basis, you depend on it. You decide on how you're going to rent those shares out. So this is a strategy that is known in the option world as the wheel strategy. At the Dorian Trader, we have changed it and called it the safeguard strategy. Right? It's trading shares and companies in a safe, methodical way, a quantitative way as well, that you can make money over time and always lowering your cost basis. So over time, you should be able to outperform the market and outperform your peers because you're always lowering your cost basis and using options to get into the shares initially. You're not just buying the shares at the spot price or the market price or the going price at that time. You're always getting at a discount. A 5% discount, 10% discount, 20% discount, 50% discount. You're always getting it at a discount. All right, so we have Apple pulled up here, and I just say you wanted to trade stocks in Apple. Well, if you go and buy the shares right now, if you buy the shares and let's say you get the mid price, it's going to cost you a little over $17,000, as you can see on the screen here. It's going to cost you a little over $17,000 to buy 100 shares. If you're using margin, it's going to be a little less than that, about $8,500. But it's still going to cost you that going rate of what the market is saying the spot price is at that time. If you decide to get into Apple by first selling a put, because the seller of the put has the obligation to buy the shares at a strike price. It's basic option terminology that you once again want to understand when you are becoming a stock trader, because it can make you so much more money if you do it this way. Now, if you sell at the 170, this Apple here, then this is going to give you a it's going to give you a premium. Someone's going to pay you $410 at the 170 strike. You minus that 410 from the 170, and your cost basis will become 165, just under 166. That's going to be your cost base. That's the most you can lose. The person who bought at the spot price, the most they can lose is over 17,000 that we just discussed. If you're going to use a margin account, it's also going to require less margin to get into the trade initially, about $3,300 here, as you can see on the screen. But you're getting it at a discount. So if Apple falls below 170 at expiration and you have to take ownership of the shares, then now you have 100 shares for every option you sold, and you got it for a better cost basis than if you just bought it right at that time. And then at that point, you could become the landlord and do what is called selling a covered call. You're renting out your shares on a monthly basis, or a weekly, or a yearly, or quarterly. You depend on that, like we said. So as you can see here, once you have to take ownership of the shares, then you can sell a call against. You got 100 shares here. You sell the call at the 175. You're basically giving someone the ability to rent to own your shares, or rent to own your house, for example. That's the contract, and they have to do it within a certain time frame, or the contract expires, and then a new contract could be created if that's what you want to do. So in this example, if you had to take ownership of the shares, now you can sell the call at the 175, and someone's going to pay you $357 for that, to sell that call. Plus you got the upside from 170 to 175. So you can potentially make, if your shares are called away in the next 41 days on this, because options have expirations, you can potentially make over $800 on this trade with a cost basis of just under 166. You're lowering your cost basis. Your cost basis at the very most would be 166 in the example that we're trying to break down here. Now, that is if you take the ownership of the shares. You can also do what is called a collar strategy if you take ownership of the shares. Let's just say Apple starts to fall, or whatever stock that you're trading starts to fall a lot, and you want to protect yourself to the downside. You can do what is called a collar strategy. That is COLLAR, collar strategy, that we teach here at the Dorian Trader. And from this collar strategy, you're starting off with a covered call, where we just went over it briefly. You're going to take some of those monies that someone's paying you for the call, and you're going to buy a put. And so in this example, someone's paying us $357, so we're going to buy a put for no more than $357. So then in this example, we buy the put at the 165. When you're dealing with options, the buyer of the put has the right to sell at a strike price. So basically, you are limiting your downside to that 165 here on your screen. You cannot lose anymore once Apple falls below 165 if you bought a put there that covers your 100 shares. It's having a stop limit. It's having insurance on your house, for example, that if your house burns down, the most you have to pay is maybe your deductible, and your insurance company makes you whole. This is the exact kind of concept when you buy a put against your shares, to protect your shares. You buy that put to protect your shares, and so now you are limiting your upside potential with the call you sold, and you're minimizing your downside risk with the put that you buy. And so as you can see here on your screen, you have the max loss of 431 now within the next 41 days. So if Apple fell 20, 30%, the most you would lose is 431 in this example, because this is called a collar strategy. This is a way you can protect your shares when things seem to be out of line or you're afraid that things are going to fall a lot. All right. And then a lot of people say, well, if I buy the shares right away, I can get the upside. We're in a bull market. Seems like everything is going up, and over time things go up. Why can't I just buy the shares and forget about it, or buy the shares and trade the shares? That's what I should be doing. Well, that is an antiquated thought process. It's an antiquated thought process. It's leaving potentially thousands of dollars on the table by not understanding how to use options, to marry it with your stock trading. Some people say, well, I want to have that unlimited upside within the next 30 days. I'm betting, I'm doing a swing trade. I'm betting that this stock is going to go up. I want to use shares so I can have unlimited upside. Where at the Dorian Trader, we teach you how to do a strategy that's within that safeguard strategy, the framework of the safeguard strategy we talked about, called the bionic bull. The bionic bull gives you all the benefit of like owning shares. You got unlimited upside, but it is still lowering your cost basis. It's still lowering your cost basis. Going back to that, that is important. You buy Apple at 10,000, and if you constantly lower your cost basis, you can eventually own Apple at zero, theoretically, or significantly less than the 10,000 that you originally put into it. This strategy that we're about to show you here on the screen is called a bionic bull. For example, we sell a put. When you sell a put, you have the obligation to buy. You're okay with that because you were going to buy the shares anyway. You were going to trade the shares anyway. So someone's paying us about 405, 410. If you get the mid price down here, 410. We can take some of those monies and then buy a call. So if we take some of those monies and let's say we buy the 175 call, and then someone still, after selling the put and buying the call, we still receive $53 into our account. If you're the buyer of the call, it gives you the right to purchase at a strike price. And you have theoretically unlimited upside. As you can see here, it says max profit here, unlimited. Your cost basis is still under 17,000, so less than the person who just outright buys 100 shares. The buying power, if you're using margin, will still be significantly less than you if you're buying shares, about 5,000 less. But you would have unlimited upside within that 41 days. And if Apple drops, then you're going to buy the shares, which you wanted to do anyway, at a discount. You're going to buy the shares that you wanted to do anyway at a discount. It's no reason you shouldn't marry options to your stock trading. If you're a beginner, you do without a doubt want to learn the basics of options so you can marry it to your stock trading. It will enhance your overall performance tremendously, and you do not want to be leaving potentially thousands of dollars on the table because you are being lazy about learning how to marry options to stock. Do not trade stock in an antiquated way. Learn it with options. Learn it with options. Now, this is just an introduction to what we believe how someone can learn how to trade stocks as a complete beginner and do it in a more contemporary way by using options, by marrying options to the stocks you're interested in. We encourage you to look into this more. Please like and leave your comments on this video. We answer all comments if you have any questions. This is a new way to think about trading stocks. It's a new way to think about trading stocks. If you trade a stock, if you buy it or sell it, the best probability you have, at least initially, is a coin flip, 50-50. If you use this type of strategy to control the shares, you're going to always have better than a 50-50 shot. You're going to always have better than a 50-50 shot to win for over a week's time, over a month's time, over a quarter's time, over a year's time, over even a longer period of time if you use options. We encourage you to look into it. With that said, we thank you for watching this video. We hope to see you in the next one. Bye for now.